Hi there, I'm Edward Galstian, founder of EKH Capital, where we look for market-beating stocks for the long run. ADP isn't just about paychecks, it's the powerhouse behind millions of businesses managing payroll, HR, and benefits with precision. We're going to break down ADP stock using the 5 key factors to determine whether it's undervalued, fair valued, or overvalued. We look for high returns on capital, strong growth, healthy financials, an undervaluation, and a sustainable moat. Be sure to like and subscribe. Now let's dive in. The first marker of a great business is smart capital allocation, ideally with a return on invested capital and return on equity ratio that is above 15%. ADP's return on invested capital is 7.9%, whilst return on equity is a much higher 93.1%, a gap worth unpacking. The inflated return on equity is largely due to aggressive share buybacks, which reduce total equity and boost the ratio artificially. Meanwhile, return on invested capital isn't ideal for assessing ADP's efficiency, as it includes all capital, equity, debt, and liabilities. ADP's large other current liabilities stem from its payroll-focused business model, where managing client funds and employee compensation inflates short-term obligations. A more accurate gauge of operational efficiency is return on capital employed, which excludes current liabilities and focuses on core business assets. ADP's return on capital employed of 57.4% is elite and a much better indicator of its operational strength than return on invested capital. Now let's talk about growth, and ADP shows impressive momentum here too. Over the last decade, revenue grew at a CAGR of 6.4%, net income grew at a CAGR of 11.1%, earnings per share grew even faster at 12.9% CAGR, hitting $9.1 in 2024. This shows that ADP isn't just growing, it's becoming more profitable and efficient over time. ADP earns most of its revenue from the US, mainly by processing payroll for businesses on a per-employee basis. This focus on a large, stable market is a strength, but it also creates a risk. If the US economy slows and companies cut jobs, ADP's revenue could decline. Although the company is expanding internationally, its growth today is still heavily tied to the US job market. Now to the balance sheet, to find out whether ADP has healthy financials. ADP's $2.9 billion in cash and short-term investments doesn't cover its $3.8 billion in debt outright. But that's not the whole story. The traditional debt-to-equity ratio isn't helpful here, due to stock buybacks keeping equity low. Instead, we use net debt to free cash flow, and on that front, ADP crushes it, comfortably covering net debt each year for over a decade. That's a sign of disciplined, resilient financials. Let's check out ADP's valuation. Right now, ADP is trading at a price-to-earnings ratio of 30.6, compared to the S&P 500's PE ratio of 26.8. At first glance, that seems expensive, but here's the context. ADP's earnings per share has grown at 12.9% annually over the last decade, which is higher than the S&P 500's 8.9% growth rate. Peter Lynch famously said that a stock could be undervalued if its growth rate is higher than its PE ratio, what we know as the PEG ratio. Unfortunately, ADP doesn't pass that test, which suggests it might not be undervalued right now. Still, if market volatility pushes ADP's PE closer to 25 or below, that could provide a more attractive valuation. ADP's primary moat lies in its scale, brand reputation, and integration within client operations. With decades of experience, ADP is a trusted provider of payroll and human capital management services to over 1 million clients globally. Its massive client base enables cost efficiencies and data insights that few competitors can match. The complexity of switching providers creates high customer stickiness. Especially for large enterprises, deeply embedded in ADP's ecosystem. However, ADP faces weaknesses in the form of increased competition and slower innovation compared to tech-native startups. Agile players like Gusto, Rippling, and Workday offer modern cloud-native platforms that appeal to businesses seeking more flexible and tech-driven solutions. ADP's legacy system and slower adaptation to cutting-edge tech can hinder agility, especially in a rapidly evolving digital HR landscape. While its scale is a strength, it can also make it harder to pivot quickly or personalize offerings at the speed of more nimble rivals. Now, before we conclude on ADP, you may have spotted the clean charts in this video. They're powered by FinChat. If you want to take your investment analysis to the next level, then click on the link in the description box below to receive a 15% discount for FinChat and unlock powerful tools to make smarter investment decisions. In my view, ADP stock is fair valued based on the 5 key factors. ADP delivers solid returns on capital with a 57.4% return on capital employed, showing strong financial efficiency. Earnings per share grew at a compounded annual growth rate of 12.9% over the last decade, which is very impressive. Debt is well managed with free cash flows that can easily pay down net debt in each year in the last decade. With a price to earnings ratio of 30.6, it's not cheap. But with ongoing trade tensions, it's one to watch. At a price to earnings ratio of around 25 or lower, it could offer better value. ADP's strength lies in its scale and deep client integration, but its size also slows innovation, leaving room for agile tech-native rivals to chip away at market share. What's your take on ADP? Drop a comment, hit like and subscribe, and let me know which stock you'd like me to cover next. Thanks for watching, and I'll see you in the next one.